Welcome to The Real Money Show, the number 18778 Silver, the website, guildhallwealth.com. My name is Jeremy Wiseman. I'm joined by Jerry Correia, and it is silver squeeze time talk in the market. Jerry, there's been a lot of videos out this week, a lot of excited silver analysts talking about your cup and handle, the 30-year plus cup and handle, where we stand in the silver market. Some are very excited and worried in some ways about what a silver squeeze could look like. Ed Steer, for instance, who follows in the footsteps of Ted Butler, is concerned about those who are shorting the market getting squeezed out and what that could look like in a potential sort of nickel issue type stuff. There are others who are more tempered, like a friend to the show, Chris Marcus from Arcadia Economics, still very bullish, but not looking for doomscalls in what could drive the market much, much higher.
Which is fine.
Nonetheless, the price of silver is up, 45% this year? It's on the back of your piece of paper here.
There it is.
And
gold's up 38% on the year to date so far. So very positive year thus far, but we have a lot of topside potential and a lot more months to go for the year.
Yeah, and I was talking with someone this morning, and a client of ours, and I was noting that, you know, in the past you would hold physical gold and silver as a hedge against the devaluing currency. And debt is a big problem, a huge problem. But it seems that the answer to the current situation is actually kind of more of the same. It is very clear that the administration in the U.S. wants a lower value dollar, obviously to help reshore. It helps for the servicing of the debt. It helps to control the debt. It's a question of, you know, the other side of that coin is inflation. So we know we're going to have inflation going forward. We know they're trying to have the Federal Reserve lower interest rates, which is going to be inflationary. Now, they revised the numbers. What was it, like 1 million jobs they revised down? Yeah, you know, that does kind of, that does say you should probably let go of the person who handles those numbers.
Right.
You know, if you're going to revise that much, you are either clearly incompetent or you are covering for the Biden administration, one of the two. Either way, if you know, I think it's warranted in some ways. We got to get these numbers right. We got to get these numbers to a semblance of what's true. But what's your take on the overall devaluing of the dollar narrative that is obviously going to continue to push this market higher and higher?
Well, the case for hedging against the U.S. dollar devaluation in all major currencies, we're seeing gold breaking out against all majors, all currencies. This is a clear sign that the currencies are losing purchasing power. Paper money is just simply losing its buying power. It's causing major banks to shift away from their typical strategy of 60% stock, 40% bonds. It's all paper. Which is causing a lot of their strategies, especially Goldman Sachs, to revise their gold prices higher to protect against the devaluation of currencies, because that's the strategy. You need to do this. You need to, you know, if you want to revive domestic manufacturing or not, they need a weaker dollar in the U.S. And that's the case. You mentioned the job situation. That is another cause for a weaker dollar. The humongous 911,000 downward revision in jobs. No surprise. We know that they did this. They beefed it up during the Biden election, trying to scour as many votes as possible or gather as many votes as possible. It was very futile. And as Scott Bessent, the Treasury Secretary, in response to this, he said it's official. They exaggerated over 1 million workers on top of what was already reported, overstating by a staggering 1.5 million jobs. The truth is that the economy in the job situation is far worse. So the argument now is for larger rate cuts. And whenever any country cuts interest rates, you weaken the currency. So the administration, there is a price expectation of a 50 basis point cut next week. So September 11th is FOMC. But there are calls for higher cuts, 75, even 1%. We'll see. But I think the case is there. They need a weaker dollar, and a weaker dollar requires a hedge, says Goldman Sachs, and that hedge is gold.
The number 1-877-8-SILVER, the website guildhallwealth.com. Jerry, you mentioned Scott Bessent. He came out on X firing full force at the Federal Reserve. Listen to this. This is crazy. Like, you would never see, what was her name? She became the Treasury, Janet Yellen, being this critical of the Federal Reserve. He said, the Federal Reserve is among the foremost drivers of inequality in America. By failing to deliver on its inflation mandate, the Fed allowed class and generational disparities to grow worse, expanding the divide between asset owners and lower income Americans. The Fed must regain its independence and stop serving the wealthy at the expense of everyone else. Very interesting, because in some ways it looks like he's trying to say, he said the word independence, right? At the same time, they're trying to take away their independence. And also independence is a red herring because
they're not federal.
They're not federal. They like to claim independence, but they're only there at the will of Congress, who's allowed them to be there. And we all know that they're a banking cabal. They wish they were independent, but their only way to be there is to slide their way into the government. And that's why, whenever a chairman would get into trouble with the Congress, he would say, look, he would say those things. He would basically say, hey, if you want to click your heels 3 times, you can go home.
That's right.
You can get rid of us. We're here because you guys let us here. So which is it? Are you independent or not? But there's been so many criticisms of them being slow. And at the end of the day, if your mandate is to keep inflation low and to keep jobs up, right? Keep unemployment low.
Failing miserably.
You're failing miserably. But why don't you admit that it's not your job to do these things? Why don't you just admit it, right? It's like it's like what we see here. Manufacture a crisis, and then we'll come in and say, we are saving you from the crisis that we've manufactured. So keeping rates high, there was no reason to keep rates high. They should have kept them, if the jobs weren't there, they should have had the rates lower.
And that's why they're calling him too late. Powell once again proved to be living up to his nickname. He's late to the show. The Federal Reserve is always late, whether it be raising too late or cutting too late. The fact is clear, though. The Federal Reserve and its nature, the crosshairs are on the Federal Reserve. They have votes are coming in, new members are coming on board. I think the time is up because you've allowed them to be, quote unquote, independent for far too long. They're not doing their job. Independence, do things for yourself, because literally we're on our own. We saw in the past 24 hours the assassination of Charlie Kirk, who advocated free speech, advocated common sense, open debate. He was a trailblazer for young voters and an advocate of truth. And our thoughts and prayers go out to him and his family and those and his loved ones. And, it was a sad day, and we're also remembering today's September 11th as well, a day that changed my life forever, and partly the reason why I'm here today, standing for truth. And when there's so many lies happening with Federal Reserve statistics, BLS statistics, inflation stats, you're on our own. You're on your own. We're in this together. And together, once you can convert out of fiat paper currency, especially hold it outside of the banking system, I believe that's a solution to fast track the solution and a lot of problem solving, especially in this independent Federal Reserve that has been the advocates of funding both sides to every single war. This machine has to be stopped. Either revamp the Fed or end it altogether. And we're about to see that happen.
Well, Michael Oliver certainly believes it could be that they could be gone within a year.
I believe so.
Ultimately, as Gerald Celente used to say, think for yourself. You got to think for yourself. Think anecdotally. Go outside, see what you're seeing. If you're not seeing it, I salute you. But if you are seeing what's going on in the real world, then there's nothing better than having real money to protect yourself. And you can do that with Guildhall by going to the website, guildhallpreciousmetals.com, pick up a tube of silver maples or a 10-ounce bar of silver. Just get your hands on something to get a sense of what this is all about. Dip a toe in the water, as it were. Or maybe you're looking to protect a larger portion of your portfolio and have some physical gold and silver as part of your registered account, RSP, TFSA, Lira, LIF, RIF, etc. We're here to help you to do that. We'll walk you through the process and make sure that you're understanding everything, every step along the way. In the last segment, Jerry, we basically said, buckle up. They're going to lower interest rates. The dollar's doomed. You're going to have lower valued dollar, which means devaluing equals inflation, equals less money in your pocket. You need that inflation rebate. You need to get some physical gold and silver in your portfolio. And they have performed wonderfully against inflation over the last 20 years. The markets are not so efficient, although they seem very efficient now with silver up over 40% this year. But, it might not be a one-to-one that, inflation's 3% by the government standards, reality maybe 6, 7, 8, or 9, and so the metals go up at exactly that rate. Could be smaller, could be bigger at times, but the fact is it's a very small market in silver. It doesn't take a lot to push it higher. It's a sort of well-known secret at this point that the retail market is not involved at all, which is interesting because what we're hearing is that there's a lot of buybacks of people who need to sell to cover expenses, etc. And that product is being melted down to go into industry. And as our listeners know, the U.S. is calling it a critical metal. Mm-hmm. Now, it's not official yet, but they've discussed it, and it could become official within a month. The fact is they've discussed it. We talked last week that Keith Neumeyer said it should be a critical metal 3 years ago.
Absolutely.
In Canada. He petitioned Canada for that. And we've talked about that on the show. So we're at this interesting point in time where, unfortunately, the retail market is selling. That product is being melted down, although there's delays, like long lineups, as it were,
months,
to get this product refined, melted and refined for industry to go into solar panels or EV vehicles or AI components and things like that. So there's this kind of turning in the market. And now we're hearing things like silver squeeze again. That now that silver's trading over $40 an ounce, there's a feeling that anything could trip it much, much higher. And those who are shorting the market could find themselves on the wrong side of history pretty quick.
Yeah, you nailed it earlier. Silver and gold is your hedge. It's your inflation rebate. It's always been that hedge to protect against that 10% inflation, year-over-year loss of purchasing power. But it's more than just a rebate, because actually silver and gold right now, not just because of inflation, because of demand and lack of supply in silver being designated as a critical mineral, you're fighting back inflation. You're not just defending, you're fighting back. You're on the assault. You want to be on the assault because we're under attack every left, right, and center in our lives. And this is one area, if it's going to be your pocketbook, at least you're going to have moves. And with what we're seeing right now, yes, silver squeeze, hashtag silver squeeze is on the rise again. And once again, it was Daniel Galley, TD Securities rep, who came out and spoke this week, and he made a very clear message, basically saying that the silver inventories out of London have been drained roughly 100 million ounces. This is silver, the free flow back and forth of sloshing from LBMA to COMEX. That float is down, trading volume severely down, and constraining liquidity is what he mentioned. predicted by our silver squeeze thesis. Last year we talked about this when you and I did the seminar in Vaughan. We played his video, and it's the same Daniel Galley. He hasn't gone anywhere. He hasn't changed his narrative, his speech. And this is a TD guy. This is a banker just like Goldman Sachs, who's like, okay, stock bonds? No, I'm going to jump on board on the silver squeeze or the gold standard. He says, we think silver markets are just starting to enter into the convex phase of this dislocation. While there are few precedents historically, such extreme scarcities in silver have been followed by, number one, significant strength in spot on a 6-month horizon, and two, have seen idiosyncratic outperformance with a 10% decline in the silver to gold ratio on average over this horizon. So he's saying we have shortages months out. You can be depleted in another 6 months. Expect the spot market silver to rise. A 10% decline in silver to gold ratio. Today we're at 86-1, Jeremy. A 10% drop. We'll be in the 70s. And that's what we talked about last week. Yeah, metal markets are up 40% on average, both metals. But really, I'm not that excited yet because the silver to gold ratio hasn't broken out. And once you get into the 70s, though, that's when you start seeing that hockey stick price up action in precious metals. And you're going to start seeing the silver breaking out above. You know, we had a great run this week so far in silver, up 2%. It's testing 42, Jeremy. Above that, it's $45. It's very easy to shred and get into that velocity acceleration stage. But the big storm we're seeing, it's in that silver lease rates. We're watching that as well. What is that? Simply put, it's the interest rate charged to borrow physical silver sloshing around.
Who's borrowing metals right now?
The bullion banks, usually from the bullion banks or central bank vaults. And when these lease rates spike, it's a clear signal of stress in the physical market. So all you need to know is that there's a lot of stress. There's a lot of worry and panic, meaning silver is getting very hard to find. We know this. Yeah. They can barely get it out of the ground. 6 years going on, structural deficits coming out of the ground. And we're seeing that. We saw that happen in the platinum market a few years ago when it broke out. The lease rates went on platinum. All roads lead to commodities. All roads lead to precious metals. That word precious connotates that they're monetary metals because we have a money problem. We have a currency problem, and that's your problem too. Everything that you're working for is denominated in a currency. You own a stock, it's denominated in a currency. Your house, denominated in a currency.
It doesn't matter what side of the political aisle you are on, your money is being degraded.
Yeah.
That is as simple as you pay more for your steak, so do I. And the only way that you're going to hedge against that is two ways. Have a business where you overcome,
or
right?
Non-beef.
You work more hours, you get a gig, a side hustle, right? You keep up, you lower your expectations, and you say, okay, no more steak. Sirloin it is. Okay, forget it. Ground beef it is. Or you hedge your portfolio. You have something that's going to hedge the devaluing of the currency. Now, we've been doing this, Jerry, on air for well over close to 10 years, I'd say. Mm-hmm. And the reason why the message has been the same is because it's a sound message. Gold and silver are real money. As such, they are finite in supply. You've pointed out very eloquently that there are deficits in the silver market. It is not so easy to just blink, snap your fingers, and have a whole bunch of silver show up at your door. And unfortunately, people are selling their silver. And,
I would love that.
I'm kind of concerned that people may be selling it under the wrong assumption. Okay, the price has gone up, so I'm going to sell. Maybe there's a long way to go in terms of educating the public. Maybe, who knows, right? Maybe they're down on their crypto, and so they're selling the metals.
Possibly.
Right? But we believe that long term, having physical gold or silver in your registered account is a great way to mitigate risk, prop up your portfolio, have a proper hedge. This is not financial advice, but it is an opportunity to hold an actual asset within your registered account. And the results have spoken for themselves. 40% up in a year. That's what you want from your insurance. I mean, that's what you're looking for. Now, if you've been in the market for 20 years in a registered account, hopefully you've made 300%. And I'd be hard-pressed, I think anyone would be hard-pressed to get those type of gains in the market, unfortunately. Yet, gold's up over 750%. Silver's up over 400%. Those gains have been done simply just by holding an asset that battles one thing, the value of the dollar.
Yeah, right.
It is the canary in the coal mine. Which leads me to one other question here, Jerry. There's been some talk about that since they lifted the gold standard, and in fact, there are rumors, I think Ted Butler maybe talked about this, I remember him discussing this, that the central banks leased out the gold, right? Because if you're not going to have a standard, you lease out the gold, and you talked about leases, which kind of falls into was when Trump said we're going to go audit Fort Knox and see if the gold is there. I wondered,
scramble
in a Tom Clancy kind of way, who he was talking to. Mm-hmm. He was talking to reporters, but who was he really talking to? Was it a warning of you better make sure the product's back there, right? Stop leasing it because you have a different person in command now. But the point I'm asking, or what I'm trying to get to here, Jerry, is that for a long time, I know that while gold has been a barometer of how well the economy is doing and how well the dollar's doing, over time you can see those gains, but on a short term, they've manipulated the crap out of it over the years. Do you think that, in other words, the canary was handcuffed and gagged? Do you think the indicators are now solid? In other words, do you think manipulation is going to be less so going forward?
Yeah.
If that was an actual thing, if, conspiracy theories, et cetera, that, it's manipulated, et cetera, do you think that that's coming to an end?
With participation, it comes to an end. You have countries hoarding. Now you have silver being designated as a critical mineral. When you up the demand, you put tremendous pressure on those derivatives. Silver has been the most manipulated market in the world, the most manipulated commodity ever in history. It's historic. And Ron Paul said it best, because gold is honest money, it is disliked by dishonest men. And they've been using gold for lease purposes over the years because gold is collateral. You can literally hand in a ton and get a lot of cash and go splurge. Really what they're doing, that's what gold has been. And when you have derivatives markets blowing up and liquidity issues and repo markets once again blinking, the signs of the times are here, and the end of the manipulation ends with participation. ETFs, we're seeing outflows of the physical, hard to get product year over year of mine deficits. So it's very clear, when you have, the fact that our Federal Reserve and our central banks are just showing us what they do, but destroying the currency at the same time. They own gold. They own physical precious metals, gold and both silver, in their reserves as a protection mechanism to protect against the devaluation of currencies plus liquidity. And that's what everyone needs right now is liquidity.
Yeah, I think from our side, we always felt that, once the central banks and the big players had enough gold in their coffers, that they would sort of just let the price go. And so, if you're trying to accumulate it, you're doing it on the sly, you're maybe manipulating markets to get your acquisitions. Once you have your acquisitions, once it's in your pocket, you want that price to rise. Mm-hmm. And it feels like maybe that's kind of happening right now.
Yeah, we haven't seen a substantial pullback. We've had a little dips. We had a dip last week, Friday, very, very brief, and we're back up and breaking out even further. So I think they're still trying to manipulate. They're still trying to push the paper markets. But again, back to Saudi buying ETFs, that was huge because if they control a major portion, a good percentage, they can not only turn off the ability to, for these shares to be used to further leverage even more into the market, But if they get into, they can actually take physical delivery through that ETF. It's a great vehicle to do.
Yeah, that's a whole different kind of manipulation, actually. Gold Telegraph just put out, billionaire Ray Dalio suggests gold as a shield for U.S. markets at risk of heart attack.
I think there's a lot of palpitations right now in the market, Jeremy.
The number, 18778 Silver. The website, guildhallwealth.com. Get your physical gold and silver through our e-store, guildhallpreciousmetals.com, and get started today, or hold physical gold and silver in a registered account, allocated, segregated, held in a vault outside the banking system. This is asset ownership, not investment, not exposure. It's ownership. Silver's doing very, very well this year. We broke through 40. Very exciting. We're starting to look ahead. Analysts are looking ahead. They're getting very excited. The cup and handle, the short-term cup and handle, the long-term cup and handle. I like that what Michael Oliver said, Jerry, that $50 was always a phantom price. But we are trading below the 1980 nominal high. Okay,
right.
There is nothing in the world that you can buy at a 1980 price.
Very true.
Not a hot dog, not a hamburger, not a Porsche, nothing. Nothing is trading at the discount that we still have in silver. Meanwhile, gold hit its all-time inflation-adjusted high this week, as noted by Vince Lancy, that we like to follow here. Great newsletter. He's always ahead. He's always ahead. I guess because he wakes up so darn early. But yeah, gold's at its inflation-adjusted all-time high. But let's not forget that the debt in the U.S. is over $37 trillion. The global debt is well above $300 trillion and rising. The way they spend money is absolutely insane. And if they're not going to get it under control, we hope they do. But if they can't get it under control, then you're letting the foxes run the hen house. And unfortunately, it means that the dollar value is going to drop. It also means more corruption. It also means these sort of crazed policies that we're seeing here in Canada. And what are you going to do about it? What are you going to do about it? Do you support the banks? Did you hear about one of these banks is putting a vending machine for drug paraphernalia?
Come on.
Yeah,
Which bank?
man. I'm not going to tell you which bank.
What?
Go do your research.
Oh, goodness.
It's like that's what you're supporting, and you can't help it. All of them are like that. You use Adobe, you use this, you use that. Not just Adobe. You know what I'm saying? Like you can't help it. But what can you do to insulate yourself and protect yourself and gain? There's a silver lining here. You don't have to just sit there and take it and just keep letting things get worse and worse and worse. You can say, I'm going to do something. I'm going to do something with my portfolio. I'm going to make a change. Am I going to sit here and let, advisor A, retire nicely that I don't speak to? I mean, we talk to our clients. We're not advisors, but we talk to our clients all the time. Nick has a client who calls almost every day, for better or worse. But we like talking to our clients. I had a client come in that bought a 10-ounce bar, spent like over a half an hour just chit-chatting about the market.
All the time,
right?
Yeah.
It's all about education and learning. And by the way, that was a great conversation. Like every single analyst, she knew exactly who they were.
Great.
Yeah, it was really fun. But that's what we do here. We're all about educating and understanding, and even things as little as someone will call and they have an idea of what they want to do in the market, and we give them a strategy for getting in. Right? Nothing crazy, but just do you have to do it all at once? Sometimes just taking your foot off the gas and saying, why don't you start small, or why don't you do half and then give yourself some chance to see what's going to go on, ladder into the market, etc. They love it because it takes a lot of anxiety away from making purchases or making sales, right? Sometimes it's, you're talking to someone, you can say, I sense the itch you need to scratch here, right?
Yes.
What's the best way to go about it? Let's talk about it, right? And we're not here to twist anybody's arm. Right?
Never.
Believe me. Look, we make a little bit going in, we make a little bit going out. We're happy to accommodate, but it's also about each of those conversations is an opportunity to get to know the situation and what the client's doing, and that educates us, helps us understand what people are going through out there, right? What the different reasons are. Like, for example, Jerry, one of the biggest things I've learned, okay, is exit strategy.
Mm-hmm.
My experience has taught me that at least 50% of someone's exit strategy is life.
True.
My kid needs to buy a house. You know, there's been an illness in the family. You know, I'm closing on a house. Life happens.
Right.
You know?
You got to sell.
You got to sell for, you know, and it doesn't matter what the price is doing that day, right? Maybe there's an opportunity. Maybe it's, you know, something that's negative in your life or whatever. There's reasons why people need to sell. And that, I think it's like 50% easy. But there's so much opportunity right now in the market. And it's really nice to have an asset that you can sell that you've made money in the market for.
Right.
And we believe the market's going much, much higher. Very quickly, Jerry, we sorry to just co-opt the mic there, but Canada's in a very, we have a very big problem economically. And one of the ways you can signal that is when companies are just leaving. And we had some news this week about a company just up and leaving the country.
Yeah, I mean, we've had so many clients leave over the past 4 or 5 years. Investors are leaving, companies are leaving. The money metric crisis that's happening, because Katusa Research reported this just the other day, and we posted this on our X. Although our mining industry has come out of 2024, 2025, launching higher, which helped stabilize the loonie a little bit, it could be short-lived because the longer-term in mining activity is collapsing. Longer-term public market activity is collapsing. Mining IPOs are at record lows. Canada's own pension giant is even putting more chips into U.S. assets. Can you believe that? Elbows up. Canada's biggest investor just ghosted Canada. The $700 billion pension fund slashed Canadian investments from 16% to 12% while boosting its whole U.S. holdings to 47%.
That's a pension?
This is, the CPP, the pension fund, divesting out of Canada, boosting investments in the U.S.
That's the complete opposite of what the Prime Minister's talking about.
Exactly.
And by the way, you can't just say mandate, it's all going to be Canada. You know, you're going to tell people to get rid of their iPhones and Amazon and Costco and CNN and Netflix and their Tide Pods and their Crest and Colgate. Like Procter and Gamble is, go into Shoppers Drug Mart, you can't get away from it. Everything is in the U.S. Over 50-60% of our economy is run on businesses that come from the U.S.
Right.
It's not just bourbon. like you got to wake up about this. I was at the airport with my wife and we were like picking out bourbons, right? And I just said, Matt, they canceled bourbon, but not Netflix. And the guy laughed. He was buying bourbon too, but you know.
But another massive move away from Canada, you have Newmont Gold, the largest gold producer in the world, just ghosted Canada as they applied for voluntary delisting from the Toronto Stock Exchange, which kind of goes against your listing. You want to kind of be listed on various exchanges for advertising purposes. However, they need to cut costs. Newmont, they're experiencing, I believe it's stagflation, high inflation leads to low growth. They're looking to cut about $300 per ounce in average costs,
all-in
costs. And they're looking to move, and they're just going to keep listed in Australia and Papua New Guinea out of all places. So they're just totally getting off. It's a huge signal, in my opinion, moving away from Canada. Lots of red tape, lots of costs. You got to watch this emissions control, that emissions control, carbon taxes. People don't want to deal with it. Companies are looking to make profit, and they're making a signal they're getting out of Canada.
The number 18778 Silver, the website guildhallwealth.com. We were just talking about the delisting of Newmont Mining from TSX. I mean, that is, you know, how bad does your market have to be when you say, we don't even need this anymore? You know, is it a protest? Is it a statement about how bad the economy has gotten in Canada or that there's no interest in mining? Now, we've all seen the mining over the last year has done very, very well. It's come out of a very long-term consolidation period or bear market, if you will, and all of a sudden they're rocking. You would think they'd want to stay, but they're not. So what gives?
Because last year they acquired Newcrest for $17.14 billion, so they're adding assets, but they're spending a lot of money, so they took on a lot of debt. And it doesn't help that your country doesn't really help you at all, or your Canadian pension plan doesn't help at all, divesting and not investing in Newmont, the largest gold producer in the world. Low trading volumes have just caused them to say, you know what, I'm out of here. Which is, for me personally, you kind of always want to remain looking at a stagflationary situation. We're looking for commodity picks. You're looking for precious metals picks. Whether you have to have the physical as a core, but then you may want to get into some mining or ETFs. But the question for me would be, what does the balance sheet of that mining company look like? Sure, the gold price is going up, but what does their bottom line look like? Are their costs going up? The costs are going up, and they're proving this. They need to cut $300 per ounce to remain profitable, or to be able to go. I mean, they're going to cut a lot of jobs.
The price of gold is up $300. It'll
Right.
go up another $300. What is that? What difference does it make?
Very expensive.
They'll get it when the price goes up $300. All right, so Newmont's leaving Canada. Canadians, all across North America, you have the retail market selling. Silver's up over 45%. Gold's up 30+% this year. Are we going to see the break above $50 an ounce? Are people too late to this market, Jerry? What is the upside potential in the market? Give me the good news.
Well, this is an indication, the reason why they're looking to reduce costs by $300 per ounce, and could also lead to thousands of layoffs for the company, Bloomberg notes. If this is a stagflationary situation, which I do believe it is, and all the signs are clear, even Goldman Sachs notes that in their latest missive, this means gold and silver skyrocket. There's pretty much only two assets that do really well besides your commodities. The two precious metals would be gold and silver. Gold outperforms during times of stagflation. This is your way to hedge against the devaluation of your currency. A lot of volatility coming up. The heart attack Ray Dalio talks says happens with share markets, unfortunately. The bout of stagflation during in the 70s saw those classic shares and the U.S. share markets crashed pretty much.
Well,
they dwindled a lot.
But what if the Fed lowers rates? Doesn't that help liquidity and push the market higher?
Borrowing is easier. Sure, they'll make it very easy for them to renew their debts, but the costs keep going up. It doesn't solve the inflationary problem. You kind of release inflation even more. So costs continue to rise. Sure, you can borrow, but you need to borrow a lot more to keep up with purchasing goods and services.
It's funny. I had a client yesterday. We were talking about the buy-in, and I've noted for myself that it's becoming over spot price to buy gold. It's more expensive than it was a couple years ago, and you just kind of think to yourself, you can't think in terms of a couple $100, for instance, because you'll drive yourself crazy, but you'll also miss the fact that gold could go to 15,000. Jim Rickards says it could go to 30,000. Lynette Zhang says it could go to 30,000. You've got other people saying it could go even higher. And you say, let's temper our expectations, take it day by day. However, if you just tack on 20% a year for the next 5 years based on today's price, you're already into the 8,000 range, right? Which means you've doubled your money. You've doubled your money. And when something costs, when it's easier to go, it's harder to go from 1,000 to 2,000 than it is to go from 2 to 3. It's easier to go from 3 to 4 and 4 to 5. The nominal amount is the same, but the percentage is lower, but it's easier and easier and easier. So it's important to get in early. It's important to not miss the party, as it were.
Very true.
Nothing's going to go up in a straight line. There may be opportunities to buy on dips, but I wouldn't sit there and wait for the perfect. No one rings a bell at the bottom, and no one rings a bell at the top. You got to just take your positions.
And we're not at the top yet. The silver to gold ratio is pointing in that direction. We don't see a breakout until we get below 70, and we're going to be approaching 70 very soon. According to Daniel Galley from TD Securities, he's expecting within the next 6 months a 10% decline in the silver to gold ratio. So you're not late to the show. You missed some good price action so far, some really good gains in the RSPs and TFSAs especially, but the excitement is still to come. You haven't missed the boat. You want to get a direct route into physical precious metals, and Guildhall offers the most efficient and direct route into the physical precious metal space market. If you're looking to just take it home, check out guildhallpreciousmetals.com. We have silver combos. We have the silver kilo bars, which are a great economical, great size. They're not too big like the 100-ounce bar, but they're a really small size, and they offer a great economy. But ultimately, it's about boost and convert out of fiat depreciating currencies and measure your wealth in ounces, and do it entirely outside of a failing currency and failing digital banking system. And you want to get in touch with Guildhall and find out more how to diversify and get your RSPs protected. If you have that nest egg at a bank and you're putting in a GIC that's giving you 3.5%, well, compare that to 40% in gold with a lot more topside potential. So you want to get in touch.
The number 18778-SILVER, the website guildhallwealth.com. If you've missed an episode, check us out on YouTube, check us out on Rumble, follow us on Spotify, hook up with us on X. Well, not hook up with us, you know what I'm saying.
Why not?
Follow us on X, and the number 18778-SILVER, the website guildhallwealth.com. Thank you to our listeners, and we'll speak to you next week here on The Real Money Show on 640 Toronto.